What's going on, everyone? This is Rob from Rob Invest, coming at you with another live video. Today we're going to talk about 3 strategies that you can do to reduce your NAV. Guys, I am not a financial advisor. This video is for entertainment purposes, so please do your own due diligence. Let's get to the video. So we're talking about 3 strategies that's going to reduce your NAV. But before we get to these 3 strategies, I need to let you guys know that this is not 100% bulletproof. This is just going to help cushion the downside blow. Okay, so let's get on with it. Number 1, dollar cost averaging. Now, when you dollar cost average, when people dollar cost average, some do it on a daily basis, bi-weekly basis, yearly basis, quarterly basis, etc. But I think the best dollar cost averaging is daily dollar cost averaging. So why do I pick daily dollar cost averaging? Because it captures all of the volatility when you are making an investment every day. Doing DCA on a daily basis will reduce your validity by 25 to 50%. So let's do an example. You have a stock, Tesla, and you're going to put $50 a day for a year. Let's say a year goes by and the price of Tesla drops 50%. Now, what's going to happen is, again, that price drops 50%, but since you dollar cost average on a daily basis, you're only going to see a 25% drop in your capital. And this is just capital. This does not include the dividends. So again, 50% in Tesla drop, but you only see a 25% drop in your capital. That's because of daily dollar cost averaging. So what's the result? Less NAV erosion and a total return increase. All right, let's talk about the second strategy. The second strategy, you're going to pair the cover call ETFs with the growth ETFs. So for an example, let's say you own QQQY. QQQY tracks the NASDAQ 100 and it does cover call ETFs on it. Now, QQQY is part of Defiance Investments. QQQY pays a 40% dividend yield, and over the past of its lifetime, the NAV has dropped severely. I think it's around 50%. So in order to combat that, you can buy something like QQQ, which is a growth fund which tracks the NASDAQ 100 as well. So with the growth of QQQ, you offset a good amount of that NAV erosion from QQQY, and you still get the dividend yield of the 40%. Now, we could do it with the S&P 500. So let's do that. XDTE. Let's say you have XDTE. XDTE has went through some NAV erosion as well. Not as bad as QQQY, but it has gone through NAV erosion. XDTE pays a 30% yield. So if you want to reduce the NAV erosion of XDTE, you can pair that with SPY. The growth from SPY is going to offset the capital erosion from XDTE. So not only that you get the dividend yield, but you also get the growth as well, which means you will reduce your NAV erosion and increase your total return. Now, if you don't want to buy into the growth funds, if you still want to stay into the cover call funds, I got you. Let's go back to the QQQY example. And you want to cover call ETF with growth and income. Here you go. GPIQ and QQQY. So if you put these two together, it's going to help you reduce your NAV erosion, and it's also going to give you a nice dividend, because GPIQ, it pays a 10% dividend. And not only that it pays a 10% dividend, it's going to give you a good amount of growth, which is also going to offset the NAV erosion by QQQY. Now, is this growth going to be more than SPY? No, because overall, cover call ETFs underperform the underlying. So you'll still get that growth, but not as much as SPYI. Let's say another example. Let's say if you own shares of Tesla. No, not Tesla, I'm sorry. If you own shares of Tesla and you want to stick to the cover call area, but with some growth. Okay, you have your Tesla, which is paying 70%. You compare that with a cover call ETF called TSLP. TSLP, this is from Curve Investment. Now, TSLP, I think pays around a 30% yield, but with that 30% yield, you're going to get capital growth on top of that, which is going to help offset the NAV erosion for Tesla. So what does that mean? Higher total returns and less NAV erosion. All right, so the third and final strategy that I'm going to talk to you about is drip. And this is probably one of the easiest strategies that you can do, because when you're doing drip, all you got to do is just basically go on your brokerage account, go into settings, and then turn it on. Now, drip is like dollar cost averaging. You're putting money in on a regular basis. So let's say you have an ETF that pays weekly. You turn that drip on, and every time you get a distribution, that goes back into the fund, which you're going to buy more shares, and which is going to increase your income. But here's the difference between daily dollar cost averaging, or just dollar cost averaging in general, and drip. Dollar cost averaging, you're going to invest in a fixed amount every day, every month, every year, etc. But with drip, the distributions are not going to be even all the time. It's going to depend on the fund. Usually, the higher the yield, the distributions aren't going to be uneven. So, if you have lower yields, like under 20%, you're going to have stable distributions. But if you're investing something like Yield Max, the distributions are going to be unstable. I mean, you'll get it every month, but they're not going to be unstable. They're going to be unstable. So, for an example, let's say if you invest in Coney pays over 100% yield, which means the distributions are not going to be stable. So 1 month you might get, well, let's just say week. Let's say if it paid weekly. Let's say 1 week it might pay $50. The next week it might pay $25. The week after that it might pay, I don't know, $10. So even though you are getting that distribution, it is unstable. I think if you combine all three of these strategies, I think you will be all set. You'll be all good to go, and you will have a good amount of downside buffer to this. Now, I want to give you guys a little bonus. So the fourth and final strategy is to do cover calls. Well, not cover calls, but do puts on these cover call ETFs. Now, I have never done puts on these cover call ETFs, and I think they would be really hard to do, because if you look at the options chain and if you look at the strike prices, it's very limited, because a lot of these ETFs, they start anywhere from $20 to $50, and they don't have a lot of expiration date selection. So I think it would be difficult to even do that, but I don't know. Maybe a few of you have done it, and if you guys have done it, let me know in the comments section and tell me how that went. But I don't think it would, just because of the choices that it has. So that's all I got for you guys. If you guys found this video informative, please like and share and subscribe. If you guys didn't like this video, put a thumbs down. If you guys have any other opinions on this video or any other strategies, put it in the comments section. If you guys have any additional strategies that you guys do that you think that can help this community, then you guys are more than welcome to put it in the comment section. All right, guys, that's all I have for you in this video. See you in the next one. Have a good one.